All right, welcome everyone. Thanks for joining us to the Tech Professional's Guide to Real Estate Investing. This is a framework for diversifying beyond your salary, company stock, and the 401k. I'm Gary Lipsky. I'm your host for today, and I'm the founder of Break of Day Capital. So many successful tech professionals have multiple accounts. Oops, sorry, but one underlying exposure. Your financial life may look diversified on paper, but your salary, your common stock, your 401k, your brokerage probably has you pretty focused in tech. But what role could real estate play in creating a more resilient portfolio for you? I've been a real estate investor since 2002. Have over 30 plus years of operational experience. I wrote two best-selling books on real estate. And my company focuses exclusively on multifamily investments. We've raised over $110 million to date and have distributed 40 million to our investors. And I started off investing in the stock market when I was younger. And I didn't like the lack of control. And that's what drew me to real estate. One, that 90% of millionaires own a piece of real estate. And I liked how I can, the tax benefits, I could force appreciation. There's lots of different ways to make money in real estate over time. And we didn't have the crazy fluctuations as the stock market as well. So it's not only me, but I have a team of professionals that have been doing this a long time, and they make me look really good. So I'm blessed to have this team. So why real estate? I like real estate. Like I said, I like the cash flow that it provides, unlike a lot of other investments. Appreciation when through better operations, through values and increase through market growth, tax advantages. How we get that is through depreciation. So we'll do a cost segregation study. Well, we hire someone that specializes that, and they front load the depreciation. So instead of taking depreciation over 27 and a half years, you're talking about carpet and flooring that won't last more than 5 years. You have appliances and other things. So on a current deal that we have, if you invest $100,000, you'll receive over a $90,000 loss in year one on your K1, and the K1 will show your ownership in that property. And with additional years of depreciation, even though you're getting cash flow, you're going to still get a loss every year. Now there's some recapture at the end, but boy, that you can take advantage of really a free loan from the IRS for let's say 5 years, and really rocket fuel your net worth. And I'll show you a slide at the end that shows you taking advantage of that bonus depreciation. Now, if you're investing through a self-directed IRA, you really can't take advantage of it. If you don't have other passive gains, you can't take advantage of it, but you can kick it down the road. You can carry it forward. So it's a great advantage. And that's why so many politicians have huge real estate assets because of the tax law. They're just taking advantage of the law. I also like real estate because it's a tangible asset, that capital preservation. It's a great protection against inflation because as if inflation hits, rents rise more than your expenses because your expense ratio could be anywhere for the properties that we have, maybe 30%, 35% because we do large properties to even 50%. And that delta on the rents is you're just making more money when inflation hits. So great inflation protection. And like I said earlier, diversification, the exposure outside your salary, company stock, and public markets. So let's look at the real estate menu, if you will. You have SFR, single family rentals, which some people have, Airbnbs, short-term rentals, REITs. REITs can be lower returns and higher fees. You have small multifamily. We do large multifamily through the syndication model, meaning we pool investor capital to do that. And then there's other commercial assets, triple net, storage, office, industrial. Each one has its own unique drivers. So you have the do-it-yourself reality. Owning a property certainly has its benefits, but you have to. There's a lot of work involved, and you may not want to create another job. And you always get a call at the worst possible moment. Maybe you're going on a family vacation, or you're going out with your significant other on a date, or you're super busy at work. That's when you get the calls that something doesn't work, or they need help with X, Y, and Z. Owning the property, you've got to find and underwrite the property, secure the financing, manage the lender requirements, oversee the renovations and vendors, handle tenants, property managers, repairs, vacancies, track financials, pay insurance, taxes, be on top of local regulations. So there's definitely money to be made if you can do it right, but it's a lot of work. So there's that active ownership, more direct control, more responsibility, more time required, direct decision making, and some people still want that. I get that. There's also the passive side where professional operator leads, like, so our organization runs, finds a deal, operates it, does all the work, potential access to larger assets, so higher return profile, very low lay, and there's no day-to-day involvement for a passive investor. But you gotta find the right sponsor. So trade-off: control versus convenience. So why a real estate syndication? So investors provide the capital, and in our case, I'm one of the biggest investors in our deals, and our team invests. Whoever you invest with, you want to make sure that the sponsor and their team are investing. So we find the deal through our broker relationships. We have thousands of data points from looking at deals for many years. We just focus on a few markets. We help execute the business plan. We manage the property. We manage the distributions and the communication to the investors. So investors are kept up to date on a monthly basis. We upload the financials on a quarterly basis. So you have all your information, all the information you need at your fingertips, and we're always, in our case, a call or email away, and we respond right away. Now, not every sponsor, like I said, is equal, so you got to do your own due diligence. One thing to note, just because you're passive doesn't mean it's risk-free. Like anything, um, there is risk involved. The sponsor, market, debt, assumptions, and execution still matter. All right, so how a deal gets put together. The return story depends on execution at each step. So finding the right opportunity and why it's mispriced or underperforming. And for us, that involves going through the T12, the trailing 12 months financials. Um, it requires going to the property, doing our own due diligence, underwriting the property. Where are there where are there opportunities? Now, we only do one or two deals a year, so we're really selective on what we choose. We also spend a lot of time finding the right structure, the debt, the equity, the waterfall, the putting together legal documents. Then once we close on the property, which is a lot of work, that's the real work begins. would say closer to 5 years. So LPs do not run the property, but they should understand the process of the whole scenario. So there's in syndication there's 506B and 506C. There's some others, but these are the two main ones. And 506B is there's more deals that do 506B, and that's for up to 35 non-accredited investors. But to invest in a 506B deal, the investor needs to have a pre-existing relationship with the sponsor, and that can entail um, a couple meetings, filling out the an investor application. On a 506B deal, you can't publicly advertise the deal. And you can accept accredited investors. Um, and an accredited investor is a single person that makes 200,000 or more a year, or a married person that makes $300,000 or more a year as a couple, or has a net worth of $1 million or more outside of their personal residence. And that qualifies you for a 506C deal. This is the SEC trying to protect the investor and the sponsor. They figure that I guess if you have these qualifications, you're more experienced in investing. It's not necessarily the case, but that's their way of trying to decide who's accredited and who's not. And in a 506C deal, you can advertise. All right, so why multifamily syndication? So it allows passive investors to receive all the benefits of real estate investing without dealing with tenants, toilets, and trash. You're pooling money with investors, so you get large economies of scale. So our most recent deal was $33 million. We're raising 13 million from about 75 investors from as little as 50,000 to $2 million. We have in our deals a pilot, actors, lawyers, accountants, you name it, they probably invested with us. So a whole gamut tech people, people like I said from all walks of life. They invest in our deals because they see the benefits of it. Investors can leverage the expertise of professional operators for their ability to source good deals, obtain favorable financing, and strong operational skills. And as a passive investor, your liability is limited to the amount that you invest in the deal. So why do we like multifamily? So, like I said, there's lots of different asset classes in real estate. We like it because everyone needs a place to live in every market cycle. And income comes from many units instead of one tenant. So if you have a single family rental and a person's not paying their rent, you're not able to pay your mortgage or you got to come out of pocket. On a 300 unit, my break even occupancy is 68%. So I can have 32 people times three, so 96 people not paying rent on a 300 unit, and I'm still able to cover my mortgage. That's the beauty of multifamily. Um, we can manage the expenses, leases, renovations, find new income lines, find ways to decrease expenses. On a bigger property, we can pay our staff more and find really good quality staff members. And we can force appreciation, not just through market appreciation, but creating real value add. And I'll show you two case studies as well. So there's four return drivers on a deal. You've got the cash flow, which is net cash after operating expenses, debt service, and maybe reserves that you're building up. Net operating income growth, either at a sale or a refinance, and then the tax benefits. So NOI equals property revenue minus vacancy loss and operating expenses. And so this is how someone values the deal, a lender or a buyer. So this excludes debt service, amortization, capital expenditures. Capital expenditures are excluded because they're one-time costs, not ongoing business costs. It also excludes interest and depreciation. And we drive NOI through increasing rents, increasing income, and reducing expenses. So a property value is the NOI divided by the cap rate. And the cap rate is somewhat arbitrary. Um, a higher cap rate usually means investors are paying less for each dollar of NOI. And that might be also in a more higher cap rate in a smaller market. Um, Maybe it's a lower class. So class A is brand new, and that you'll pay a lower cap rate versus let's say a class C, which is going to be a little bit more rougher as well. Um, Los Angeles, where I live, that's going to have a lower cap rate as well because it's a major city. So there are other factors, and you want to find something that there's the in place cap rate, and then there's the brokers. This is the cap rate you can get it to after you do X, Y, and Z. So if NOI rises, value rises. If cap rates rise or go down, then that can also affect the value. And right now, we're in a very high cap rate environment. That's the highest I've seen in 10 years. So it's a great time to buy. It's a very bad time to sell or refinance because the values are compressed with expansion of the cap rate. So hopefully I didn't confuse you. A lot of terminology, but you'll get the recording and have access to the deck if you'd like as well. All right, so this is what I promised, a case study, real quick of how we forced appreciation. So this was a deal we bought in February 2021. So COVID was going on at this time. It was a student housing deal. When we bought it, occupancy was around 52%. It was poorly managed. A lot of kids weren't there. And we bought this and converted it to multifamily and got to over 90% occupancy within 6 months. So greatly increased the NOI in a very short period of time. And you can see down below 114% NOI increase in year one. So huge, huge upside. We also installed solar to reduce electricity costs. So it reduced our expenses again, increased the NOI. We also worked with the city. This took a while. It took almost a year. Anytime you're working with the city, it takes a long time. But there was a bunch of 4-bed units, and we just didn't need 4-bed units. We needed more 3-bed, two bed or 1 bed. And so from the 4 unit, we created a 2+1, 2-bed, 1 bath, and a 1+1, 1 bed, 1 bath. And so by splitting it up, the 4 unit, the 4-bed, we can get I forget, somewhere was like 1650, 1750, something along those lines. But a 2-bed, 1 bath, maybe we were getting like 1300, and then a 1 bed, 1 bath was 900. So now you can see that spread, that 2300 versus 16, 1700. So that's a nice little bump in NOI multiplied by 12 months and divided by the cap rate provides a huge value to the property as well. And then we did some landscaping plans and new parking on the property as well. So we sold that in 39 months. It was a 19% IRR. IRR takes into account time value of money when that money is returned to you. and it was a 1.7 equity multiple. So if you invested 100,000, you got $170,000 back in 39 months. Here's another case study. We bought this property in December 2023. And when we looked at the T12, and we looked at the expenses, we saw the water was really, really high compared to our other properties. And so based on the same amount of units. So we knew there was either a leak, a major leak, or they didn't have low flow toilets and shower heads. And we were able to figure out pretty quickly that that was the case. They didn't have the low flow toilets and shower heads. So we replaced all the toilets on the property in 1 week. They were using 3.5 gallons per flush, and the new toilets 0.8 gallons per flush. So massive water savings. And also with the shower, the low flow shower heads, and the faucets, we're also able to decrease the amount of water usage. And so that's saving us over 138,000 a year. And when you divide it by the cap rate, that's almost $3 million in value we created. They also had too many people on their payroll. So reduced one person without hurting operations. They lacked charging of pet rents. And then we also installed privacy patio walls on the first floor and got a bump as well to our income. And so this increase in value, it's an unrealized gain until you sell the property. And so based on cap rates, it can go up, it can come down, but increasing income and reducing expenses has a huge effect on the value of the property. All right, so I started talking about some of these metrics. I had mentioned IRR, internal rate of return, and that, like I said, it's that time value of money. There's cash on cash, and so um, you'll see here in this row, that's the cash on cash. So um, year one on this deal was projected at $4,000, so 4% cash on cash. Second year, 5% cash on cash. Third year, 6%, and up from there. So if you take the average, that will give you your cash on cash. Now, again, these are projected numbers on a deal. There's no guarantee. There's the equity multiple. So if you invested $100,000 in this deal and you got back 200,000, that's a 2x multiple. And that does not include any tax benefit. So you might have gone a massive loss through the bonus depreciation, but these are just the returns to you in real dollars. Then there's also AAR, average annual return across the life of the investment. So if you invested 100,000 and got 200,000, your AAR is 20%. So 100 divided by 5 is the 20%. So it's pretty important to understand how returns are structured, and that waterfall should be explained in the PPM, the private placement memorandum. So you want to read those documents very carefully. The lender, the senior lender, is paid back first before any equity, and then any if there's mezzanine debt on there or preferred equity, they get paid back first. Then LPs, and then in our deals, our investors get paid back first. Then the sponsor gets, who would be us, a piece of that waterfall. Not all deals work that way. Sometimes the sponsor is getting paid back, getting paid their share right away. We like to make sure our investors get paid back 100% of their money first before we get a piece of the action. And the preferred return, sometimes you might have a 5% cash on cash and a 7% preferred return. That is usually accrued, but not compounded. And sometimes the sponsor has a catch up and gets a piece of that action too. So just again, read the PPM before you invest in any deal. There's no guaranteed return. So it's important to understand three common mistakes investors make. And we've seen these, we've seen many more. Chasing the highest projections. Again, their projections, anyone can manipulate their numbers, mostly through overly aggressive rent growth or overly aggressive cap rate compression. And so it's really important as an investor not to judge a deal based on who's got the highest IRR. It's really important to focus on the sponsor, um, because they're the one driving the deal. A good sponsor can take a bad deal and make it good, and a bad sponsor can take a good deal and make it bad because they don't have the experience. Um, they don't have the operational acuity. Um, there's a lot of different reasons. So really get to know your sponsor. And on our website, you can download our my Amazon bestselling book, Invest Smart: Spotting Red Flags in Real Estate Syndications, and that goes through 20 red flags that you should look out for. Also, another common mistake investors make is letting a sponsor learn with your money. And what I mean by that is maybe the sponsor hasn't done very many deals. Maybe they're in a new asset class. Maybe they're in a new market. These are really important factors that you want that experience. You want, full cycle deals. You want them doing deals in that asset class and in that market. That's very, very important. Sometimes a sponsor without that experience can perform very well, but you'd rather have them learn with other people's money, not your own money. And the third common mistake I see investors make is they've got a 1031 and they do a deal just to do a deal to save money on taxes. And there's these small windows of time, and it's really hard to find the right deal and make it work. Sometimes it does, sometimes it doesn't. I mean, we've had an investor invest $2 million with us because they didn't want to do that. They didn't want to sign on the loan. They didn't want to rush a bad deal. They felt confident in us and invested a very large sum. They got the depreciation, so they mitigated their tax liability, but they didn't enforce the 1031. And so, like what I said earlier, a projected IRR is not a promise. So you want to make sure you understand what has to be achieved to get this return. Is the rent growth supported by comps and current market conditions? Are expenses realistic? Are they growing in their projections the way they should be? Insurance is skyrocketed a few years ago. It's since settled down, but that's something you need to be aware of. We invest in Arizona, where there's a max of 5% growth in taxes every year. But in some states, they are reassessed every single year and you have to fight it. We like that assurity of where it's going to be, and we can underwrite to that. Also, in Arizona, you don't have the natural disasters, and that's why they build these billion-dollar chip factories. So we have um, a much lower insurance cost than many other places. Debt. What happens if interest rates increase? How long is that debt? Does it meet the business plan? What's the current lending environment, and how will it evolve over the years? If it's a great lending environment, then you've got to predict for a worse lending environment. Or where we are now is pretty reasonable, but you've got to have buffer. If someone is underwriting to perfection, that just doesn't happen. This is a business. Each property is a business, and there's going to be ups and downs and curveballs, and you've got to underwrite for that. And what is the exit value? Is the sale assumption conservative, or dependent on cap rate compression? So, like I said before, you've got to start with a sponsor and not the deal. What's their track record? What's their focus? Are they a mile deep in one strategy, or are they dabbling across many different asset classes across many cities? Now, if this is a massive um, private equity firm that you're investing with that's been doing it for decades, then yeah, I could understand that they have multiple asset classes they invest in multiple cities. But for the most case, that shouldn't be uh, someone you invest with, and that's why we just focus on a few markets so we could be experts in those markets. Look at the team. Is there a continuity plan? If you're investing with just one person and they don't have a team to back up the deal if something happens to them, that's a major problem. And I've invested in a deal like that, and I lost all my money. That was a lesson, a hard lesson that I learned years ago. Communication. Do they respond right away or do they take a long time? Or are they transparent in what's going on? Not everything goes perfectly. And are they communicating the good and the bad? Is there alignment? Is the sponsor investing alongside the LPs? You know, are they getting a ton of fees up front, or is it more back end? That's the kind of alignment you want. You want to make sure they're rewarded at the end. If you do well, they do well. So here are some questions you might want to ask a sponsor. Um, what could cause this deal to miss projections? How much capital is reserved for unexpected expenses? So in a deal like ours, a 300 unit, when we do our due diligence, we'll bring out electrician, plumber, roofer. We'll walk all the units. We do a lease inspection. We're checking every single thing. And even if we get a good report, like the roof is fine, for a property, a big property, we might put in 200, $300,000 in reserves just in case things break. Now, maybe I won't use it for the roof. Maybe I'll have extra reserves for HVAC or something else. I wanna build in lots of different buffers because not everything is going to go perfect. Things break, particularly when you put something in escrow to sell, and you're holding a deal for let's say 5 years, and over time things get damaged. So you need that protection. What happens if rents grow slower than projected? What happens if the exit cap is higher than underwritten? Um, how often will investors receive updates and financials? These are the things you want to know ahead of time. So why now for multifamily? This is a great time for multifamily. Be fearful when others are greedy and greedy when others are fearful. And now in multifamily, we're seeing the highest cap rates in over a decade. We've had probably a 4 year pullback um, in values, and historically over hundreds of years, we've seen a very long run up after that. Now it's not gonna be straight up and a massive returns, but over the next 11 years, we should see a nice curve up um, in values, and the fundamentals are strong. Interest rates are reasonable. It's certainly not where they were when they were giving away money years ago, but we are on the last deal we did 6%. It's very reasonable. 5 years fixed, 5 years interest only. So the fundamentals are really strong. We bought a deal that is cost us half as much if you were to build new. Now, it isn't new, but tremendous value. It really protects investors' money by buying it well below replacement value. So what about retirement funds? So we have plenty of people that invest through their self-directed IRA. They may have to move money from, let's say, old 401ks where you used to work if you transfer jobs. And to set that up takes about 2 weeks, but we can connect you with some companies that we like to work with. We are not a custodian and do not provide legal and tax advice, so you'll have to seek that out. But we can set you up with a custodian, um, and just be aware of some of the rules that they have. So tax efficiency accelerates wealth. So, as you could see from this graph, if you invested, let's say, in the stock and it had the same return profile, but obviously no bonus appreciation over 20 years, you'd get a return of $950,000. But with bonus appreciation, it's $1.6 million. So huge driver for net worth. It's something that I've taken advantage of by being investing heavily in real estate. So next step, if real estate could play a role in your portfolio, we'd love to be a part of it. We have plenty of educational resources on our website, on our YouTube page. So feel free to go to our website. You can sign up, see our latest deals. You can get a copy of my books, Invest Smart or Best in Class. Best in Class is a very technical book on asset management. And feel free to schedule a call. I'm happy to talk to new investors, find out what you're looking for. It's not a sales call. It's to get to know you and to see if we have anything that fits what you're looking for. We have some investors that come in right away after seeing a webinar, one of our offerings, and we have some investors that come in 6 months down the road, 12 months down the road. It's really up to you. You're on your own journey, but we'd love to be a part of it and get to know you. So thank you for spending the time with me tonight. I look forward to meeting with you in the future, and good luck in investing. Thank you.